Two people, same city, same year, both 29 years old, both earning $68,000 a year, both working in project management at mid-size companies, both opened a brokerage account for the first time during the 2020 pandemic, both watched the market drop 34% in 23 days, and panicked. Fast forward to today, one of them has $487,000 in investment accounts, works 40 hours a week because he wants to, not because the math says he has to, and is 3 years away from what most people would call early retirement at 51. The other makes $91,000 now, a real raise, real progress. He has $14,200 invested. He is not irresponsible. He is not reckless. He did not blow his money on anything stupid. The difference between these two people is not income. It's not some secret stock tip or a hot ETF someone whispered about at a dinner party. It's what they did during 3 market crashes. And more specifically, it's whether they understood one mathematical concept that Wall Street has always taught its best clients and almost never explains to anyone else. My name is Elena, and I spend way too much time doing the math that financial advisors find inconvenient to explain. Here's the one number you need before we go any further. According to Dalbar's quantitative analysis of investor behavior, the average investor earned 3.6% annually over the last 20 years. The S&P 500 returned 9.8% over that same period. Same market, same time window. A gap of 6.2 percentage points every single year for 20 years. That gap is not because most people picked bad stocks. It's not because they had a bad financial advisor. It's because they did the wrong thing when the market went down. Not wrong in a complicated way, wrong in a very specific, very fixable way. By the end of this video, you'll know exactly what that thing is, why the next crash is not your enemy, and how to use the next downturn, and there will be a next downturn, to do something most investors never do. If that sounds useful, hit subscribe, because this is the kind of math I run every single week. Let me introduce you to Marcus. Marcus is 31 years old. He lives in Columbus, Ohio, rents a 1-bedroom apartment with beige walls he's not allowed to paint because the lease says so, and earned $72,500 as a supply chain analyst at a mid-size logistics company. He has a Roth IRA he opened 3 years ago with genuinely good intentions, $6,400 in it currently, and a general sense that he should be doing more, but he's not exactly sure what more looks like. Marcus is not careless with money. He doesn't carry credit card debt. He brings lunch to work 4 days out of 5. He has a gym membership he actually uses. Not ironically, genuinely. He enrolled in his 401k when he first started his job, and then paused contributions when his rent increased by $280 a month in 2023. That was a completely rational decision under the circumstances. Marcus also checks his Roth IRA balance during market drops. Every time. He logs in, sees the number down $800 or $1,300 or $2,100, and feels that specific dread of watching something you worked for get smaller. Then he waits. He doesn't sell, but he doesn't buy either. He waits for things to stabilize before he adds anything. That instinct, waiting for stability, is costing Marcus somewhere between $180,000 and $300,000 over the course of his investing life. And he doesn't know it. Here's the concept. It's called dollar cost averaging, and technically you've probably heard the term. Most people have, but I'm not going to explain it the way most people explain it, because most people explain it like it's a consolation prize, something you do because you don't know what else to do. What I want to show you is that dollar cost averaging during a market crash is not a fallback. It is the single most powerful compounding accelerant available to a regular person who doesn't have a hedge fund or a private wealth manager. And the reason almost nobody uses it correctly is because it feels completely wrong when it's working. Let me show you how this actually plays out in the real world. The S&P 500 has crashed, meaning a drop of 20% or more, 7 times since 1990. The 2000 dot-com collapse, the 2008 financial crisis, the 2011 debt ceiling panic, the 2015-16 correction, the Q4 28 sell-off, the 22 COVID crash, the 22 rate hike cycle. Here's what happened after every single one. The index recovered. Every time. The average recovery time back to all-time highs, 2.1 years. The COVID crash of March 2020, 34% drop in 23 days, recovered in 5 months. The 2008 crisis, the worst in a generation, recovered fully by 2013. This is not a prediction. This is a 35-year historical record. Now here's where the math gets interesting, and I want to walk through this carefully because the number at the end should stop you cold. Imagine the market drops 30%. Not hypothetical, it happened in 2020. If you had $10,000 invested before the crash, it's now worth $7,000. Most people experience this as a $3,000 loss. They log in, they see red numbers, they wait. But here's what that drop actually represents if you're still contributing. If a share of an S&P 500 index fund was worth $100 before the crash, it's now $70. You are being offered the same share you were going to buy anyway, for 30% less. Every dollar you contribute during a crash buys more shares. More shares means more of the entire recovery belongs to you. This is the mechanism most people intellectually understand and emotionally cannot execute. Marcus earns $72,500 a year. After taxes and fixed expenses, he can realistically contribute $400 a month to his Roth IRA. He isn't right now, but the budget is there. That's our starting number. Scenario 1. Marcus contributes $400 a month consistently. But when crashes hit, 3 of them over the next 30 years, a historically conservative estimate, he does what most people do. He pauses contributions for 4 to 6 months until things settle down. 3 crashes, 6 months each. 18 months of missed contributions total. $400 a month at 8% average annual return for 30 years, $587,000. That's real money. Marcus should feel genuinely proud of that number. Scenario 2, Marcus contributes $400 a month every month without exception. During those 3 crash windows, the market is down an average of 28%. He doesn't get a bonus. He doesn't increase contributions dramatically. He just doesn't stop. He buys the same shares at a 28% discount and lets the recovery compound. Final account value, $730,000. The difference, $143,000. Not because he contributed more dollars in total, he contributed $7,200 more in principal, 18 months of $400. But because he bought at the bottom, those shares compounded from a lower cost basis through every subsequent year of growth. $7,200 in extra bottom of market contributions produces $143,000 in additional retirement wealth at 8% over 30 years. That is not a math trick. That is compound interest working with market volatility instead of against it. Now let me add one more layer, because $400 a month is good, but during a crash, Marcus has a bigger opportunity sitting in his savings account and he doesn't know it. Most people with Marcus's income and discipline keep somewhere between $8,500 and $14,000 in a high-yield savings account as an emergency fund. 3 to 6 months of expenses, which is exactly right. That money stays there. We're not touching it. What I'm describing is different. A separate crash fund, $1,500 to $3,000, built deliberately during calm, boring market periods and deployed only when the S&P 500 drops more than 15% from its all-time high. The 2022 correction ran from January to October of that year. 10 months. If Marcus had set aside just $200 a month starting in mid-2021, when the market was at all-time highs and nothing felt dangerous, he'd have had $2,400 in dry powder by the bottom in October 2022, when the S&P was down 25.4% from its peak. $2,400 deployed at the October 2002 low, the S&P recovered to new all-time highs by late 2024. Those shares were worth roughly $3,430 by then, a 42.9% return in approximately 18 months. On an index fund, during one of the worst market years in a decade. Not a startup, not a crypto token, a boring index fund. The crash is not the problem, it is the setup. And most people miss it because they're too busy waiting for it to feel safe. Here's why this feels hard. And it's not because you lack discipline or financial knowledge. I want to be direct about that. Before 1978, most American workers had defined benefit pensions. Your employer carried the investment risk. You worked, you retired, you received a monthly check regardless of what the stock market did in March. A market crash was someone else's problem, specifically a professional portfolio manager's problem, because that was their full-time job. Then the 401(k) was introduced. Then IRAs became the primary vehicle. Then financial responsibility was quietly transferred from institutions with dedicated investment teams to individuals who have full-time jobs doing something else entirely and are now expected to make rational, emotionally neutral investment decisions in the middle of everything else happening in their lives. A 2021 Vanguard behavioral finance study found that investors who received guidance during market downturns outperformed those who managed a loan by 1.5 percentage points annually. Not from better stock picks, purely from not making emotionally driven decisions during volatility. 1.5% per year, compounded over 30 years, is the difference between a $400,000 retirement account and a $700,000 retirement account. Same market, same index fund, same contributions. Just different behavior during the red periods. And here's the thing. Nobody in the financial media ecosystem gets paid when you hold through a downturn and do nothing. CNBC doesn't benefit when you stay calm. The anxiety that spikes when your portfolio drops 18%, that physiological response is not a personal weakness, but it is being amplified every day by a content machine that profits from your attention. And your attention peaks when things are falling apart. In 1990, the average American investor checked their portfolio a few times a year. Today, the average retail investor checks their account 7 to 10 times per week. More access to information during a crash does not produce better decisions. It produces more fear, more reactive selling, and a larger gap between what the market returned and what you actually collected. The math didn't fail randomly. It failed in a specific direction for a specific reason. This is not a personal failure. This is structural. Let me show you alternate Marcus. Same salary, same beige walls he can't paint, same coffee order. Alternate Marcus does one thing differently. Starting in January 2022, when financial media was already running recession headlines and inflation was front-page news, he quietly sets up an automatic $500 monthly contribution to his Roth IRA. Not because he felt confident. He did not feel confident. He felt like everyone else felt. He set it up anyway because he'd read once that crashes feel more permanent than they are, and he decided to trust the 35-year record instead of the current headlines. From January to October 2022, Alternate Marcus invested $5,000 into an S&P 500 index fund, while it fell 25.4%. His average cost basis per share over that window, approximately $367. By December 2024, when the index reached new all-time highs, those same shares were trading around $510. On top of that, Alternate Marcus kept his $500 monthly contribution running straight through the recovery. No pauses, no waiting for a signal. At 55, Alternate Marcus has $612,000 in his Roth IRA. Marcus, the original one who paused during crashes and waited for stability and did everything else identically, has $391,000. $221,000 gap. Same income, same city, same investing timeline. Alternate, Marcus contributed approximately $22,000 more total over 30 years. The extra $200 a month crash fund deployed during 2 downturns. That $22,000 in additional bottom-of-market contributions produced $221,000 in additional wealth at retirement. Here's the number that should genuinely stop you cold. He did not get rich because he was smarter, or because he worked harder, or because he got lucky. He got rich because he understood that fear is not a signal, it's a tax, and he refused to pay it. There's a man named Ronald Reed. He grew up in rural Vermont, hitchhiked to school because his family couldn't afford transportation, and spent his working life as a gas station attendant and later a janitor at JCPenney in Brattleboro. He drove a second-hand Toyota. He held his winter coat together with safety pins. A stranger once paid for his breakfast, and he didn't correct them. Ronald Reed never earned more than $30,000 in a single year. When he died in 2014, at age 92, he left an $8 million estate, $6 million of which he donated to his local library and hospital. His portfolio contained 95 individual stock positions, many held for decades. He bought shares of blue-chip companies during every downturn he could reach. He held them. He reinvested every dividend. He did this for 65 years. He did not have a financial advisor, a hedge fund, a tip from a connected friend, or a single stroke of luck beyond the luck of starting early and refusing to stop. $8 million. Gas station attendant. Safety pins on his coat. The compounding strategy I'm describing is not new. It is not clever. It is not complicated. It is just difficult in the way all things requiring patient, counterintuitive action during periods of fear are difficult. Boring behavior executed consistently during moments when almost everyone is doing the opposite. So here's what this looks like as a real, practical plan, not a philosophy, a plan. Step 1, set a fixed monthly contribution and automate it today, not when you feel ready. Now, even if it's $150 a month, the automation matters more than the amount because automation removes the decision from the emotional moment. The money moves before fear can weigh in. Step 2, build a crash fund separately from your emergency fund. This is $1,000 to $3,000 that has exactly one permitted use, buying broad market index fund shares when the S&P 500 drops more than 15% from its all-time high. You build this during calm, boring periods. You deploy it when every headline says not to. Step 3, when the next correction arrives, and statistically, a 10% correction occurs roughly every 11 months, you do not pause your automatic contributions. You let them run. You deploy the crash fund. You close the brokerage app. You do not check your balance more than once per week. Step 4, when financial media starts using the word recession in every headline, that is your signal that the fear premium is near its peak, not a sell signal. A confirmation that your crash fund and automatic contributions should both be running. Step 5, run the time machine calculation on your own number. Whatever you can realistically set aside per month during a correction window, even $100, plug it into a compound interest calculator at 8% over 20 to 30 years starting from the bottom of the next correction. Put that result somewhere visible. That number is your anchor the next time the market drops, and your instinct says, wait, here's what I actually want you to feel right now. Because $612,000 versus $391,000 on a spreadsheet doesn't feel like anything. What the $612,000 version of this story feels like is waking up on a Tuesday morning in your early 50s and realizing you don't have to take the promotion that comes with 60-hour weeks and a manager you don't respect. It feels like your child's college education being covered by money that existed before they started first grade. It feels like going to the doctor without doing mental arithmetic in the waiting room. It feels like the specific, quiet peace of knowing that if your company announces a 30% workforce reduction next quarter, your family's life does not fall apart. That is not a number. That is margin. That is the thing you are one market crash away from having significantly more of, if you know what to do when you get there. The crash is not the threat. Missing it is. If this changed how you're thinking about market downturns, not just what to do, but why the fear you feel during them is a known, documented, structural response that the financial industry has never had much incentive to fix. Hit like and subscribe. I run this kind of math every week, the kind that doesn't usually show up in your feed until something is already going wrong. See you next week.